Good afternoon from California, everyone. My name is Adam Lashinsky. For several more hours, I am executive editor of Fortune magazine, and I'm delighted to be with you here today. Although I, of course, I'm sure, along with the rest of you, would rather be in a giant ballroom in Los Angeles, but we're gonna do the best we can. We have a distinguished panel of investors who I'll bring up onto the screen in a moment. There they are: Orlando Bravo, Anu Duggal, Anton Levy, and Deven Parekh. I'm going to start by asking everybody an icebreaker question that they've been completely unprepared for. And Anton, I changed the icebreaker after our conversation in the green room. I'd like you each to say what month and year we will look around and say to each other, normality or normalcy has completely returned, and very briefly why. And Orlando, I'll start with you.
What an icebreaker. I'm going to say, so I'm not a scientist, see, I leave that to others. I'm going to say June 2022.
Why so far away?
Mm-hmm. I just, we've gotten hit so hard and it's still really uncertain, and we have an uncertain fall, and, the vaccines, people have done so much research, but what's the effectiveness of them? Who's going to take them? How do people adjust back to maybe a hybrid model? People don't know how we're all going to, quote unquote, come back to an office environment potentially. So all that, I would just say, 2 years from now.
Thanks for going first. Anu?
Sure. So first of all, thanks for having me. I do think it depends on how you define normality. I don't think we're going back to kind of the pre-COVID world after all this is done. In terms of a date, my guess would be January 2022, and very much along the same lines of what Orlando mentioned. I think if vaccines are distributed, call it late spring, it's going to take at least 6 months, I think, for people to feel comfortable that A, they're working, and B, that they're willing to kind of go back to social norms, eating in restaurants, not necessarily wearing masks all the time. I think there's a social and psychological aspect of this that is going to take some time.
Okay, thank you. Anton, can we get a little optimism, please?
I'm gonna be a bit more optimistic and say by August of next summer, I think you're going to see herd immunity emerge. I think you're already seeing aspects of it in different localities, even pre-vaccines. I think the vaccines are going to increase the percentage of herd immunity that exists in different places. So I don't know if you'll have 100%, Adam, return to normalcy, but I think it'll be a thing of the past where people talk about this is what COVID meant for me. This is what COVID, its impact was. Even, to Anu's point, I think you're going to have permanent changes, but I think you're going to be 95% on your way in less than 12 months.
Okay, thanks, Deven.
Well, Adam, first, just congratulations on a great career at Fortune. Thanks for having me, and we're excited to see where you end up next. I'd probably kind of combine all these answers, which is that I probably agree. One is I think the psychological impact is high, and I don't think that for 2 years people can kind of stay in the circumstances that we're in today. So I on one hand, agree with Anton that I think by summer of next year, a combination of herd immunity and vaccines is going to probably get us all comfortable to going back out and interacting with people in a way that we've used to interacting with them. That being said, I think to Anu's point and Orlando's point, I don't think that going back to normal, and to use a business context, is going to look anything like it used to look. I think we're all going to reconsider whether we needed to travel as much, whether we need to go to all the meetings that we actually go to. And so I'm probably more of the view that it's going to take longer, if ever, that we actually go back to working the way that we used to work.
All right, but obviously we're all going to go to Milken Global when it's held in person next. Okay, so I know you're not scientists or epidemiologists or doctors, but I wanted to hear your view of the future, because the future is our remit for this hour, and the future that we're talking about is the future of software, and that's probably a lot more optimistic and a happier topic than than talking about when we'll get over the pandemic. So, again, in the same order, I'd like you each to share a few top level thoughts and do this. Talk very briefly, please, about your firm in terms of your where you play in the what asset class you play in primarily, and then secondly, what your software thesis is. Be fairly brief. We'll cycle back around and flesh it out as much as we can. Orlando, please.
Yeah, so we play in buyouts, right? Companies that have been around really over 10 years. But it's interesting, in the last 5 or 6 years, it has turned to growth buyouts, because we have believed that deep value has not existed now in software for a period of time. So we entered 5 or 6 years ago these highly innovative sectors in cybersecurity or some in infrastructure. We've done some deals together with Deven and some others. I think our first thesis is that software is just the best industry to invest in. And we didn't know really how good it would be when we started over 20 years ago buying our first software company, but it made so much sense the more we learned about the business model, about how these companies behave during crises and how important they are for their customers. And now, talking about something really optimistic, we are really convinced that software is everything. It will, in 5 years from now, no longer be considered an industry or an industry vertical. It's a business model. And you're so intertwined with your customers, given the way software is being delivered and given the operational aspects that it's improving versus the gross margin improvements that it was doing or focused on 30 years ago, that 5 years from now, people will just look at it as a business model and a diversified industry. I'll say one more thing is, really, in the history of the space in business-to-business software, the solutions were focused on solving gross margin problems at companies. What I mean by that is supply chain issues, materials, resources, etc. With the advent of software as a service and cloud computing, new companies started solving really big problems, operational problems, where 80% of the cost of companies are, where people can work a lot more productively. And that's just starting. And that's multiples of the size that the industry was some years ago. So that's our big thesis in terms of why we're excited about the space.
And thank you. And fair to point out that we're using software right this very minute in multiple ways, and wouldn't have been able to do this without it. So it's sort of, to that extent, it's self-evident. Anu, please.
Sure. So Anu Duggal, founding partner of Female Founders Fund. We are a seed stage fund investing in companies started by female founders. Surprise, surprise. To go back to your point, Adam, I think looking into the future, one of the observations that we've had in terms of themes is that there are a couple things that have really stood out that I think have been accelerated through COVID. And the first one I'll touch on that we're excited about has really been the consumerization of healthcare. And I think you've seen with the rise in the use of telehealth throughout the pandemic, there are a lot of other, I think, verticals and industries within healthcare that are realizing that software can really accelerate how they reach their end consumer. For us in particular, we're investors in a company called Maven Clinic, and which really focuses on women's health. And I think what we've seen through that is that, whether it's pediatrics, whether it's senior care, whether it's chronic disease, using telehealth and using software in specific to really reach that end consumer that we're really interested in. I would say another important one to mention is workplace efficiency tools. So, obviously we've all now become very familiar and comfortable with Zoom and other similar platforms. But I think, there's a long way to go in terms of what that user experience looks and feels like if we are truly adapting to, a more permanent even if it's semi-work from home scenario. And so I do think that we're seeing a lot of entrepreneurs address that as a potential opportunity area. And then third, I think, is another trend that we've been tracking called the rise of the alternate community. And I think that, as you're seeing the unbundling of Facebook from a platform perspective, you're seeing more and more niche communities emerge that are focused on very specific areas. So it could be motherhood, it could be religion. There's so many examples, I think, of groups that are finding, digital connection in today's world. Again, just leveraging software as a tool.
Great. And before we go too much further, I just want to remind our audience that I will be able to take your questions if you submit them. They'll be sent to me by text in text form, and I'll read them toward the end of the hour and turn them to the panel. Before we move on, Anu, would you just take a moment, and I think we can all assume why Female Founders Fund, why you're focused on female entrepreneurs, but rather than us assume, I'd rather hear it from you.
Yeah, so I mean, our belief is that, if you take a step back and look at the numbers, historically less than 2% of venture capital has gone towards companies that are led or founded by women. And the fund was really formed with the belief that that is going to change and the fact that, there are going to be billion-dollar companies that are built by women who are taking both their professional insights and experience as well as their consumer insights to solve problems and build products and really address opportunity that hasn't been done before. And so, we've now invested in 45 companies, and it's been incredible to see how much the industry has changed since the fund launched almost 8 years ago.
Great, thank you, Anton, please.
Maybe just quickly on General Atlantic, we are a growth equity investing firm, which basically means we're investing in companies that are growing fast. And for us, we define growing fast as 20 to 300% plus annual growth rate. A lot of our investments are minority investments. We are typically 80+% of the investments we make are minority investments. And that's really driven by the fact when you have a company that's growing 50, 100% plus, typically there's not an opportunity to buy control of that company because most of the investors and entrepreneurs and CEOs feel like you're in the first or second inning. So as a result of being involved with the best companies, we tend to be minority-led investors. And just to give people a feel, we typically write everywhere from as low as a $20 to $40 million check all the way up to $1 billion plus check in any one company. I'd say, just maybe a couple other things. One of the big themes that we see and have been investing in for a while, which we're seeing accelerate, is really the global emergence of the global entrepreneur. I mean, we've had entrepreneurship in the U.S. For a long time, and that's definitely accelerating outside of Silicon Valley and all over the United States. But we're also seeing that accelerate all over the world. Lots of new hotbeds everywhere from to places in multiple cities in China, starting with Beijing, places like Sao Paulo and the like. And that's been something that we've been early in trying to capitalize on, and we're seeing accelerate significantly. I'd also say maybe just for folks who aren't involved in the market every day, like some of my other panelists here, I've been investing in software and technology investings for multiple decades. And the opportunity set today is as great as I've ever seen it. I mean, the number of amazing companies, the number of amazing entrepreneurs that are now leveraging great business models, connectivity, all of the infrastructure that's been put in place over the last decade or so is really incredible. I mean, again, having done this for a long time, just the number of companies and the quality of those companies is really, really remarkable. So I agree with Orlando. I think Orlando said software is everything. I think we might not use that exact term, but I think we believe that software is eating, to use someone else's quote, kind of eating the world. And we're seeing it across industries. We're seeing it in places like financial services, healthcare, almost every industry, energy, so on and so forth. Just software is taking more and more of that ecosystem, more and more of the economics, more and more efficiency. And it's just an exciting time to be involved in that ecosystem. And I think it's going to be an exciting time for the next decade. And for all the negative implications globally of COVID, one of the really big positives that a lot of us see is just the accelerated use of technology and digital has really exploded across industries. Some accelerating 10 years plus in time, and others, maybe 1 or 2 years. But it's really been an acceleration, which has been really remarkable to watch.
Anton, let me get you to linger for a moment on this issue of global investing that General Atlantic does. The headlines and beneath the headlines are that we're living in a time of polarization internationally, decoupling between the United States and China, which you mentioned, and many other, contentious trade issues. How, if at all, does that affect your investment outlook for software outside the United States, where your fund is headquartered?
We talk a lot about it, and it does impact it a lot. I mean, I think we continue to be bulls globally on entrepreneurship and innovation. China, which is at the center, the China-U.S. relations, which seems to be at the center of some of those tensions. We're big investors. We have 3 offices in China, and it's been one of our best markets to invest in. But increasingly, it's important, particularly export-driven Chinese companies, and it's always been a risk factor. It's a bigger risk factor today. I'm an optimist. I think we're optimists around the U.S.-China relations. I think it's in both countries' interests to figure out how to coexist, even though there's some different values and approaches. But it's a risk factor, and particularly for those external businesses. So we are cautious on certain export-driven businesses where a Chinese company part of the thesis might be selling around the globe. Or a U.S. business that part of the thesis is to move into China aggressively. I think we're discounting those cases more heavily and taking a more cautious approach than we otherwise might if things were headed in a different direction. I do think long term, though, the governments are going to learn to coexist because it's in everybody's interest and to do it in a way that makes sense for both those countries.
Yeah, I agree with you. I was in China last in November. I actually passed through Wuhan on my way to Guangzhou, and when I got to this big Fortune conference, nobody wanted to talk about trade tension at all. Everybody wanted to talk about doing commerce with each other. It was really kind of extraordinary. Deven, thank you for your patience on getting into the fray. Please give us your wind up, if you would.
Sure. The hard thing about being on a panel with people you know and respect is I like to disagree with people, but actually there's a lot to agree with on what's already been said. First, just quickly on Insight, we like Anton's, like GA, our growth equity fund, but the distinct that we only focus on software. And we do anything from kind of early growth investing, which would be a $20 or $25 million check, all the way to control transactions. And the vast majority of our control transactions are kind of growth-oriented buyouts. So kind of 30% growth or higher is our typical strategy. And I think a lot of good points were kind of already made. I was talking with a hedge fund manager the other day, trying to understand his kind of view on where software multiples are today. And he said that his quote was, software is God's gift to capitalism. One of the things that I'm struck by, and I think all of us have probably had a similar experience, is we all sat there in March when we all left our offices and saw kind of an economic decline that's certainly unprecedented in the lives of the people on this panel. And I think we all were expecting we're going to have to batten down the hatches. And we all did. I think we assumed, at least in Insight's case, that we would probably do very little investing over the course of the next 6 or 8 months, that we'd have to cut expenses in our portfolio companies, which we did. But while we did all those things, the companies actually ended up performing way better than we expected. And it goes to something that has already been referred to, which is that these software systems are so embedded in the workflow of these companies that they really, in almost every industry, that they really can't operate without them. So the things that we expected to see, like big upticks in churn or significant decline in new bookings, it didn't really happen. And what we saw instead was what Anton talked about, which is kind of a tremendous number of really, really interesting companies to invest in. And I went back and just checked before the panel how many deals we'd invested in since COVID. And we've done 27 new investments since COVID. And I never would have predicted that. We're sitting there in mid-March. And there's a number, and we come back to some of these themes, but I think there's a number of trends, and I think Anu hit on a few of them, that make up a big chunk of those 27 companies, if I took it to a higher level. One is kind of workforce collaboration, broadly defined. Zoom's the best example of that. The platform we're on today is an example of that, but there's a lot more ways that people need to be able to work effectively together without being in the same place.
Mhm.
Been a big theme for us. Infrastructure and security continue to be a big theme, because what you're going to see is a continued accelerated migration to the cloud, which means a whole new set of innovation on the infrastructure layer. And then what we call kind of the digitization of the customer experience, which is, I think, what every company realizes today, that they have to have the digital channel is not the alternative channel. It's likely to be the main channel. And so everyone's investing very aggressively in making sure that customer experience is a great one. And whether that be healthcare, where the regulatory dynamic of 5 to 7 years of regulatory change happened in the span of a few months, right? But that meant a lot of technology investment. Walmart probably did 5 to 7 years of CapEx for e-commerce in the span of a quarter or two. And then last is, category I'll call consumer subscription. A lot of people have actually had more free time at home. And there's a lot of kind of content and services that companies that have kind of very effectively capitalized on that. So those are four themes. There's more that we could kind of on, but happy to go into that in more detail.
So where I'd like to go next is we have a financially savvy audience, and Deven, you brought up multiples. Orlando, you brought up the issue of there isn't a lot of deep value available in software right now. Period. I'm going to go in reverse order. I want you to talk about valuations a little bit in your asset class where you invest. Talk about where it is and what the dynamic. I don't want to say where it's going, because I tend to get the answer you're looking for, but what the dynamics are in valuations right now. Deven, start with you.
Look, I think the thing, and I think we've all been guilty of it, myself included, is that I don't think most people can think that companies can compound at a high rate for a long time. If you compound 20% growth for 20 years, you've grown the business 39 times. And that's, everyone understands the power of compounding, everyone understands it, but the actual numbers are staggering. And so when you think about valuation, we have a line we use internally. We never overpay. Companies just miss their numbers. And what we mean by that is that if we actually underwrite to the right growth assumption, we're generally not overpaying. That our focus really needs to be on making sure that we understand what the long-term growth of that business can be. And a great example of this is Salesforce. You could have bought Salesforce in the public market when it went public and made 62 times your money using no leverage, which sadly probably beats the performance of everybody on this panel, except that very few people did, because nobody believed that Salesforce would continue to compound at scale, and it did. And once people realized that, the multiple re-rated. And so I think the trend that you have in software is two things. One, you have a secular trend where you're able to compound at a rate that almost no other industry can, or no other industry can. And then the second thing you have, particularly in enterprise businesses, is this concept of net retention, right? And so to use an example of a company that we're not investors in, Snowflake, it's got a net retention of north of 150%. So what does that mean? For every dollar in January, they have $1.50 the next January without adding a new customer. So they've got 50% growth without adding a new customer. There's almost no other business model you can find where that type of potential exists. So I'm not making the analytical argument that the valuations are what they should be or not, but particularly with growth, if you pay, I'm just going to use a very aggressive, you assume you pay 20 times revenue for a company, not profits, 20 times revenue. And if it grows at 100% a year, well, it's at 10 times in year 2 and it's at 5 times in year 3. And if you look at an 80% gross margin business, it probably has a long-term margin of 30 to 40%. So you actually can construct a valuation construct that can justify the multiples, assuming your growth rate assumption is correct.
Yeah, okay, good. Anton, please. Valuations.
I mentioned there's more amazing companies now than being created and at scale than at any time in my career, which is amazing. On the flip side, we're not the only people who have noticed that. Neither myself or the others on this panel, and so you have seen valuations elevate, and they are at elevated levels in both the public and the private markets. I'd say a couple things to go along with that. One is that I've gotten the valuations are elevated question now for probably 7-8 years from my colleagues to LPs, so on and so forth. And if you actually look,
remember, in my defense, I didn't say are they elevated. I just said talk about them. But go ahead.
Sorry.
I said I never said anything about them being elevated. I just said let's talk about them. But go ahead.
No, I think they are elevated. I mean, I think they are elevated, but I think, maybe for some good reasons, as Deven pointed out, for sure. But I think also valuations have been elevated for 7 or 8 years. If you actually look in mid 2013, there was a big uplift that you saw sort of mid-year, and valuations have stayed elevated really since the beginning of 2013, based relative to historical norms. And there's some subsegments that have gone up and down during that time period. And even in the last maybe 6 months here, maybe you've even seen a little bit of the higher end of that. So maybe think valuations are 20 to 30% higher than they were on average relative to those last 7-8 years. But we've been operating in an elevated valuation environment for some time, in software included. And I think a lot of us on this panel and elsewhere have managed to make attractive returns. And I think there's different ways you do it. And I think, as Deven said, it's about investing in the right assets. I mean, you look at companies from Amazon on down, it's about getting the right companies. He used the Salesforce example. There's a lot of other ones that can compound and that can grow for extended periods of time. And so I think what we all try and do thoughtfully is be involved in the best companies. We'd rather pay lower prices than not. One of the other things that's going on in our industry related to that is what a lot of us do also, is we're trying to make investments a little bit earlier. So we used to have at General Atlantic a minimum $75 million check if you go back 7 or 8 years ago. And now we'll write checks that are in the 20 to 30 to 40 to $50 million range. And the reason for that is we want to be involved with companies, the best companies. And what happens is they continue to scale, we'll continue to press those winners. And that's been a big driver of us. I think now about 35% of our investments are follow-on investments in our portfolio. And that's a reflection of the valuation environment. We want to get earlier. We're moving to click earlier so we can have a seat at the table for those best companies and allow us to continue to press as opposed to approaching company for the first time once they're already relatively large. So I think you're going to, low interest rates and other things are driving high values, but and it's hard to predict the exact future. But I think we've been in this valuation environment for a while, and we may continue to be in that environment for a while. And I think all of us have learned to navigate that. Maybe the last thing I'd say is, look, I think we're waiting for that valuation correction to come. We've been waiting for it, again, for a while. But I think that's also going to create great opportunity when that happens. We call it our Pearl list of companies we track and get to know that we're ended up not investing, usually because of the valuation being too high. And we're, not that we wish a valuation correction per se, because of the economic fallout that may bring. But on the other side, it's going to be a great time to invest for long-term investors when that correction comes and when these companies are on sale. It's going to be a great time to invest for the next decade. And so I think a lot of us, on this call, ourselves in particular, are preparing for that and have been for some time, and that'll create amazing opportunity when that arrives.
Good. I know that valuations for seed investments is a sort of a screwy topic to begin with, but you still have to make a decision. So share with us, how you think about valuations, both as a matter of principle, or always and now.
Yeah. So, I would say at the beginning of COVID in March, the assumption was that, over the course of the next 6 months, we're going to see valuations come down. And I think what's been really interesting is two things. One, at least at the seed stage, they've actually remained stable. And two, we've actually seen an increase in terms of the number of entrepreneurs that we actually interact with. And I think, part of that may be due to the virtual nature of how we're all working today. But I also think that entrepreneurs are addressing, some of the issues that have come about through COVID, kind of going back to some of the themes that I mentioned. So I would say for us, we're fairly valuation sensitive as a smaller fund. So we have ownership targets, and I would say, even now 6 months post-COVID, have been able to maintain those. But I would say, the expectation was definitely that we were going to see those valuations come down as capital became harder to find. And that definitely has not happened.
Has not. And just so our audience can have a sense of the breadth of investing that we're talking about on this panel, Anton mentioned $75 million being a small check for General Atlantic. What is a typical check for Female Founders Fund?
So we're currently investing out of our third fund, and at the seed stage, we lead deals. Our average check size is anywhere from $750 to $1 million.
Great. Okay, that's the C. Good. Orlando, you started this with your comment on deep value. Tell us your thoughts on valuation, if you would, to the extent they haven't been covered yet.
I'll try to summarize, because I think there were so many great comments on valuation. And investors, regardless of stage, you really want the same things. You look at things very similarly if you've been around for a long time. You want that growth, profitability, culture, management, etc. The question of valuation is all relative. The question is it better than the alternative? For us, 22 years in software, we have been lucky to stay in enterprise software, because enterprise software for our style has always been better than the alternative. And it is so today. Let me try to unpack a little bit about what we saw in March, which Deven spoke about. It's better in a crisis, right, if you're a good operator, to be overly cautious than overly optimistic. And staring at these things in March, the first issue is there were some hedge fund blogs out there saying, well, customers won't be able to pay the subscription revenue. So this recurring revenue that has been great in software is going to come under attack. We were nervous about that, but that did not make sense to us. If you bought the right things and you know how important it is for the operations of your customer, you should be okay. You may have people going out of business, but you should be okay. So that certainly happened, right? For the third time, right? It happened in the dot-com bubble burst, it happened in the global financial crisis, and it happened again now. Lending credibility to the stability of the model, to where you stand. I like to say that software subscription was more stable than real estate rental income. One of the most safe asset classes that people have said, right, for a long time. So that was one. But then the second piece was, can you sell any new? And can salespeople sell over Zoom? And you have this industry where salespeople on site and hang out with customers and do all this. That happened as well. And then what we didn't see, and we began to see it in May, June, as the quarters were closing, is that many of these companies that we all own were a big solution to the current problems that were going on in the world. So you mentioned healthcare. We have a company called Imprivata that does cybersecurity for hospitals. So for all healthcare workers, when you come into a hospital, they know who you are. You can log in once. You can spend more time with your patient. And with people going from institution to institution and being overworked, that was a key solution in the market. And we started noticing that and saying new companies are here to solve new problems. And that software is about new companies and entrepreneurship. So the market sees all this. And for the third or however many times, they see the stability in the model as well. And the sector takes a step function increase in valuations once again. Now, is it justified? And, a couple of you mentioned it, when you extrapolate these growth rates that are certainly possible in these areas that are providing so much value to their customers, in areas that are new, with cultures that are innovative, you can justify it. For us, the issue, though, is can it be operationally executed? The market's there, the product's there, the excitement's there. Can you actually hire, 1,000 salespeople, right? In our flagship fund, our minimum equity check size $750 million. So to grow at a certain rate, you really have to have a certain operational cadence. And by the way, in our view, that's where the software industry has a long room of improvement. Because today, if you look at $1 trillion market cap in the SaaS space, okay, on average, those companies lose money. The average EBITDA margin of a SaaS publicly traded software company with $1 trillion market cap in total, the best, the biggest, is negative 3%. That's when the industry was when we started 20 years ago, at negative 5%. And that's about doing innovation correctly and hitting those targets. And it's certainly possible. And that's partly what our industry does. It is focuses on the right things to be able to innovate better.
So you made a perfect segue into the next topic I wanted to ask everybody. I think there's total agreement on this panel, probably in the world, that software is one of the great investing opportunities. It's one of the great industrial opportunities out there. But I want to flip the coin and ask you all to focus on risk for a little bit. And Orlando, I think you just said your concept is the operational risk for these companies is significant. That's how you earn your money as an investor. First of all, fair paraphrase. Would you highlight that as the biggest risk?
Sorry, which risk?
I mean, I think you said a moment ago that the opportunity is great, but you still have to make money, and I'm saying you're flagging that as an investment risk. If the company doesn't make money, essentially eventually it's not going to make money for you, right?
Yeah, I think we've been really lucky as industry participants. In every about 5 years of the industry, there has been the big risk, right? In 2000, if you look at those first 5 years, the big risk was that Microsoft was going to put all these smaller companies out of business. And Intuit had a great strategy, right? It was called Right for My Business. So they were doing big things. And where did these small players feature? Well, that kind of didn't happen, but it was a big existential risk, right? There have been other times where it's open source. There have been other times when it's the transition to subscription, which is quite complicated because on the one hand, you have access to the operational expense of your customer, which is that much bigger than CapEx. By the way, that's one of the areas where software is 10x the size than it was before. But holding on to your customer is a lot more complicated because you better improve your product so that price can follow given the labor inflation that goes in this market. So there has always been that big risk. There was the big risk, as some of you mentioned, about valuation. Does the sector get revalued? So I don't, we've been through that, and that doesn't seem to be a big existential risk to software. I do agree that it is the ability of companies to operate, and if you miss it, and you miss a product development cycle, I'm just not talking about profits and margins. If you miss a big sector change, you see so many companies that are being formed out of the same business, out of the same company that lost their way, and that's what you need to watch for.
But so I want to go around the horn. Anu, what's the biggest risk you feel you face as an investor?
Well, it's an interesting question. And I think, kind of going back to where we were in March, one of the biggest risks, obviously, being in venture capital is the fact that, to your point, many of these companies are losing money, and they're putting millions, if not, tens of millions into online customer acquisition, and marketing and paid marketing. And so I think one of the things that we really honed in on during that period was actually pushing our company to think about profitability much sooner than I think they originally had been planning to. And I think, to Deven and Anton's point earlier, we have since been pleasantly surprised about some of the growth rates in categories like whether it's digital health or e-commerce. So consumers are still spending. But I do think that, there has been a renewed focus on, what would it take to get to that level of profitability.
Yeah, good. Deven, how do you view risk? What is it for you?
Well, I'll add something. I mean, some of the comments, I won't repeat what's been said, but I think I think the other risk here is innovation. I mean, I think that the thing that more often than not, when we end up not investing in kind of a later stage kind of buyout business, software business, it's often because our growth and part of our growth business, we've kind of identified 3 or 4 emerging competitors who have a cloud native architecture, who don't have the tech debt of the incumbent, who have the ability to come in at better price, better customer experience, better stickiness, better user interface, more open APIs. And I think you're going to see those cases where an incumbent is not successful in kind of making the transition, right? I mean, the best example of that is look at Salesforce. I'll go back to Salesforce. Look at Siebel. Siebel just was slow to make the move to cloud, and Salesforce created. Now, Siebel got sold for $6 billion. It wasn't like the worst outcome in the world. And I think that's one of the beauties of our business is kind of our losers, so to speak, are not really that bad. They just tend not to grow. And then Orlando comes and makes them a lot more profitable and everything's okay. I think it's an absolute risk. And I think it's a risk that we spend a lot of time looking at is how defensible is this company's product position? And the other risks that have been identified, I agree with, but I'm just adding something different.
Great. And Anton, take on the risk, and then I'm going to have a follow-up question for you, and then I'm going to go to audience questions. So please send them in.
Yeah, I agree with everything that's been said. I mean, I think, one of the things with our portfolio is that there's a bit more perhaps of a natural resiliency in our portfolio, given most of our companies are profitable or running break even. Some lose money, but it's clearly for investment and growth and can be profitable very quickly.
Give us a quick illustrative example from the portfolio, if you would.
Sure. So a company like Squarespace, which has, software company subscriptions, recurring revenue, and they have really two expenses: marketing spend and headcount. And if they want to drive profitability they could be 50-60% growth, EBITDA margin business by reducing marketing spend in the short term. I mean, they have the revenue that's very sticky, and they happen to be profitable anyway, but they can control their profitability really at any moment in time. Now, the marketing spend is for future years' growth. So if you cut marketing spend down or to zero for that business, it'll start to affect 2022 revenue, but for the next 2 years, it'll almost have no impact. And so you can really, have a significantly profitable business, and that applies to a lot of software businesses that have really stable top line. So that's one example. Look, I'd also, just to Deven's point, I think, the thing that people get wrong, I think valuation is one of the biggest risks in today's market. I do think that, Deven's right that if you have a business that's growing 50, 100% plus, and they can grow at those rates and be 30, 40, 50% EBITDA margin businesses at scale, you can justify some of these values. But the issue is that not all businesses are going to be that. And to Deven's point, things like moats, where you're going to draw competitors and people might lower price and other things could drive down those margin assumptions. And maybe it's a 15% margin business, not a 40% margin business. I think making that judgment call is really important. So I do think that in addition to execution risk and the other things people have mentioned, I do think you're in a high valuation risk environment. And, we're not doing a lot of investments in really good companies because people are outbidding us by 30, 40% on price. And in the short term, we may make some mistakes and have made some mistakes in the last few years, but the things we've done have been great. And so, our loss ratios are very low. And, again, maybe we're missing a couple of high flyers, but we generally sleep really well at night on those. So I do think that this valuation environment will come to roost. I don't know if that's going to be in 1 year or 5 years, but I think, having seen some other high-flying valuation environments, they typically don't last forever.
Anton, I want to ask you a related and what may seem like a silly question. Now, none of you specifically invests in public securities, but Anton, explain to the audience why we are in an IPO boom right now and how long will it last? And if you want to focus on software, that's fine, but it's no different right now for software than for anything else, right?
Yeah, I would say you're probably in the best IPO market of my career. I was also around in the 1999-2000, so maybe that rivals it as a high boom time. But I think part of the reason for why is a fewfold, and we've touched on some of them on this call. One is the low interest rates, which people are willing to pay a lot for growth. Two is we're in an innovation supercycle at the moment, and a lot of companies are growing at elevated growth rates and compounding at very high growth rates and continuing to compound at very high growth rates. Three is the business models of a lot of these companies that are, whether it's software or other business, a lot of the business models for these companies are fabulous, high margin, recurring business models that people, these are businesses that investors want to own and are willing to own for 5 to 10 years, given the size of their market and the attractiveness of their business model and the moats, which I think is also something that for the best businesses goes untalked about a lot. Finally, I'd say there's a dearth of product. As much as the companies are staying private longer, it used to be companies would go public when they maybe had 30, 40, 50, 60 million in revenue. The time to stay private is extended. And so companies, whether it's Airbnb or some of the large software companies, a lot of those companies had stayed public until billions of revenue. And so I think just there's the dearth of product. And so there's demand, whether it's retail investors, institutional investors, hedge funds, mutual funds. Some of those companies have moved into the private markets to get some of that product. But a lot of those people can't or don't have the resources or ability to help those companies. And so they've struggled a little bit doing that. So I think it's a combination of all those factors combined with this innovation super cycle. Maybe the last thing I'd say is, look, some of it's justified. If you look at the 5 largest companies in the world, they're technology companies, and none of them existed 30 years ago. And these are the Googles, Apples of the world. And so I think people are also saying, look where market cap has been created. And a lot of it's been in tech companies. So it's been, you look at the top 25, you look at it in China, you look at it in any market, and you see where market cap is being created. It's these innovative, high growth companies. And it does move into some areas like biotech and others. It's not just, pure software tech. But that's where the market cap is being created. And people are smart. They're looking and saying, all right, where for the next 10 to 20 years is market cap going to be created? And I think people are realizing a lot of that's going to be in these innovative areas. They want to be long innovation. And I think that's the call. There'll be ups and downs in terms of values and markets, but I do think you want to be, for the next 30 years, you want to be long innovation.
Adam, just one point, just quick point, was that if you just look at in the last 20 years, the number of public companies halved, and the amount of capital that's gone into public investing is up dramatically. The number of growth dollars in growth public funds is probably up 5 or 10x. So the supply demand imbalance is actually very, very large. And then you couple that with an innovation cycle that's driving a lot of growth, and that just makes for a good environment for IPOs.
You raise a great point, Deven, and I'm just trying to wrap my head around it for anybody to jump in on. We went through this period of time where the conventional wisdom was that it sucks being a public company, and that people could make their list of 17 reasons why it sucks being a public company, and we don't want to be a public company. Even public companies didn't want to be public companies, and now we're in an IPO boom. So, yeah. Again, I'm trying to make sense of the previous conventional wisdom.
Well, I think the one thing I would just
as long as you can trade at 30 times revenue, you like to be public. Go ahead.
What I was going to say is,
it's like, we'll take it.
I think these arguments get made, but really there's a valuation undercurrent to those arguments, right? Meaning that if you're going to get valued the same way in the public markets as you are in the private markets, well, you'd probably rather be private and not have to deal with earnings releases and Sarbanes-Oxley and public boards and activists and all of that. But if you're going to get valued at twice the multiple or 3 times the multiple in the public markets, the private markets, I think people are generally willing to live with the friction of being public. So I tend to agree with Orlando's comment.
Fair to say the 45 companies that you've invested in would like to be, the CEOs would like to be public CEOs one day?
I think it varies. It depends on the industry. It depends on the multiples. But there are definitely quite a few of them.
Okay, let me change gears, and I'm gonna throw out a question from the audience, from left field a little bit compared to what we've been talking to. This member of the audience writes, "What about ethics and software? Is there anywhere you think software is having a negative effect?"
Yeah, I'll take that, because we actually been spending a lot of time in AI. And in AI, it's something we spend a lot of time about, because you really have to make sure that you understand the explainability of the models, right? So let me use an HR example. If we decided to automate the HR process for Goldman Sachs and said, I'm going to take the data from everybody who's been promoted to partner at Goldman Sachs over the last 20 years, and then I'm going to run that against every new resume I get, you're not going to end up with a lot of diversity in your pool, right? And so I think that, for example, we just made an investment in a company that basically is AI for fair lending, right? And so that really looking at the underlying biases that can kind of come into making loans as you go to more automated lending, which is clearly more of a trend. How do you actually make sure you're creating a model that's taking into account the fact that you have these racial differences, and making sure that your model is actually explainable, right? So I actually think AI in particular, and you can see that also from a policy standpoint on a global basis. I think this was a topic at the Milken Asia conference, around if you just look at the differences in policy between China and the US as it relates to AI. There's a kind of different standard of what we as in the US are willing to have as be effectively public data versus China. That does give them some advantages in AI because data is kind of the oil of AI. So the more data you have, the better your AI systems are going to be. And I think we've just kind of made a decision as a society that there's maybe some spread you're willing to have to not have that level of data be available.
Anyone else?
I would add to that. So I think what we've seen over the past few months has been when you look at social platforms, whether it's Facebook, Instagram, Twitter, there's been a renewed focus on ethics, and I think in part because a lot of these platforms, when they were created, they weren't necessarily built keeping the customer's privacy in mind first. And what we're seeing on our side, again, we invest in companies started by women. So, whether it's Whitney Wolf at Bumble or Seema Sistani at House Party, we've actually had active conversations about the fact that they have taken product decisions that have actually slowed their growth potential in order to ensure that their customers' privacy is really first and foremost. And so, I think when you look at Facebook as a great example, people are coming off that platform because they don't feel safe and they don't feel like it's a net positive experience. And so I do think that there is a big opportunity to create what that next generation of platforms will look and feel like, but taking an approach of, what does that user want to feel like versus optimizing for kind of that super high growth roadmap.
Good. Orlando, there's a question from the audience specifically for you, which is, what industries do you think are most attached to software, and which industries do you think are least attached to software?
I was going to say the same industry, financial services is so attached to software, except insurance processes have lagged because of all the homegrown systems, and their workflows are not nearly where they could be. So within financial services, I would say trading and the banking industry and more financial transactions that happen very quickly are so intertwined with software. Capital One is a good example. The CEO says that they're really a software company and a technology company with a financial services business model. And that's their core competency, and that's why they can win in the marketplace. On the other hand, insurance is once again a slower mover really into this space.
And do you feel like you've invested successfully in that theme? And could you share it if so?
We have, one of our most successful investments, which we exited recently. Right during the pandemic, we would have never thought we could exit a company like this at this kind of value during that time. Is we had a company called Ellie Mae that streamlined the whole mortgage process from beginning to end. It's a mortgage in a box in terms of what the solutions that they provide to the overall ecosystem of that industry. And this is a company that it did benefit from low interest rates, but it did benefit from the tailwinds of innovation and changing workflow processes that can be done a lot better, a lot faster, with a lot better information using technology. We bought the company 17 months ago for about $3.5 billion, and we recently exited for $11 billion. And the company's just a wonderful business doing great.
Great. We just have a few minutes left. I want to ask each of you one last leading question, which is, and this is a variant on a question from the audience. So I'll read the question, but then I'll reframe it a little bit. What else are you betting on for the future, aside from tech and software? I know, Deven, you said you're exclusively software, but in just about a minute or so, give us a sense of what interests you or what you're investing in that is beyond pure software or is tangential to software. And I'll just go in reverse order of where we started. So Deven, to you first. And I may have to speed a few of you up if we start to run out of time. Go ahead, Deven.
Yeah, Mike, we don't, as I said, we really are pure play software. So, I mean, I think that what I would say is the theme that we're starting to see is we're seeing kind of more, I'll call them tech-enabled, software-enabled services, right? So you're effectively, if you think about Anton's earlier comment about how software is going into every business, that's true for service businesses too, right? So we're investing in software solutions that help automate law firms. We're also investing in software solutions that actually do the AI solutions that do the contract review process, which historically would be some work that might be actually done by lawyers. So I do think, and it's a longer panel conversation of like what impact does that actually have on even some white collar verticals. I think it actually has some impact on white collar verticals. But what I would say, and again, in our case, these businesses what we're investing in are all software, but there are some that are effectively using a software solution to enable a service.
Yeah, or verticalization. Quick anecdote. A buddy of mine and I worked on a story together. I paid a transcriber to transcribe my interviews. He used an AI tool to transcribe his interviews. We both got to about the same place, him at considerably less expense. Anton.
So quickly, just to add, first of all, life sciences is an area that we've made a big push into recently. We think life sciences itself is a massive. It's been talking about you want to be long innovation. We think you want to be long life sciences innovation. We think that's a huge opportunity. There's also a huge overlap with life sciences and software and data. So we see a lot of synergy with our core business and have been growing that business pretty aggressively and so far successfully over the last couple of years. We're also pushing global even more. I mean, I think, we talked about global entrepreneurship and innovation. We recently opened a Jakarta office. We've had a renewed push into Israel. We've done a number of other deals in the Middle East. And what we're seeing is in all these other corners of the market, entrepreneurship is exploding. Technology, innovation, the solutions that some of which we take for granted, there's demand for that in populations all over the world. And one of the things that, again, we're doubling and tripling down on our end is the network effect that we've created across our 15 offices. Because whether you're a software business that's based in New York, London, or Beijing, your software might be applicable in markets around the world, and helping you take your service offering all over the world has been a really big opportunity that we're doubling and tripling now.
Thanks, Anton. Anu.
Sure. So I'll touch on the three topics I mentioned earlier, and then a couple of other ones. So consumerization of healthcare across a variety of different areas. So pediatrics, chronic disease, menopause, all of these, we think have tremendous potential. The second is
excuse me for interrupting you, as non-software investments.
Yes. So when you say non-software, I would say this is the general kind of category that we're investing in. It doesn't have to be a pure play software investment. Right. So an example would be, recently invested in an at-home blood testing kit. The software part of that is less, I think the main focal point of that business, but it is tech enabled, as Deven mentioned. And then I would say another category that we're interested in is senior care. So, when you look at just the pure size of the baby boomer market and the lack of products and services that really speak to that audience, I think whether it's a tech play, a pure tech play, or a tech enabled play, a lot of potential there as well.
Thank you so much. Orlando, you got a minute for a non-tech interest or thesis.
But that's easy because I can do it in 30 seconds for us. Software. We spoke about it, right? We said software is everything. Everybody on the panel, software has the best business model out there. And one thing that we didn't talk about, we talked about extrapolating long-term growth rates. But in software, when you get it right, you distribute your product immediately all over the world. There's no supply chain, there's no waiting. You push a button and it's there, and everybody's on the latest instance of the product. So when you get it right, it's really an incredible place to be, and that's what happened to us in Ellie Mae. We were lucky; the company got it right, and the EBITDA went 5x in 17 months from where it was before.
I just want to thank the four of you for taking time out of your busy schedule, and as to pick up on the theme of where he started, I hope we can all be together in person soon. Have a great rest of your day and week. Thank you very much.
Thanks, Armin. Good luck in your next career.
Thank you. I appreciate it.
Thank you.
Thanks.